There will be MCQs on the relationship duration. So the same risks what we discussed already in the previous topic, the risks that you have like default risk, liquidity risk, all these are important while you're deciding how much should be the coupon. So the company has to decide whether they should give 4%, they should give 5%. So they will keep always a benchmark. The benchmark is whatever government is paying. So if it is a private company, no one will come if you pay the same thing what government actually is paying. That's obvious. So you have to pay a little more than that. So how much is the challenge where we come into picture as a CMA? We also need to look at the tax. So there is a tax benefit that gives for us, because every time actually you are paying interest, you can reduce it from your earnings. You remember earnings before interest and tax minus interest, then only actually earnings before tax comes. So there is a tax benefit that we are getting here. That's why it is called this interest or coupon. One more terminology. Interest is before tax. So there is a tax shield. When we will be studying capital budgeting, the same language, same calculations, everything is ditto. So you pick up this words and terminology and how to calculate the bond valuation. You'll be able to easily do any projects, whether it is investment into building or highway, any capital expenditure. We'll be able to easily do that. So there also we use the same language, tax shield. The meaning of tax shield is I am able to save tax by reducing this expense called interest. That's why you can see that what is the tax calculation. So let's see with the numerical, then we'll understand this formulas much more easy. The market interest rate for the bond is currently at 5%. Now they are saying that there is a municipal bond which is interest tax exempt. So they're saying the municipal corporations in whichever state in the US, they are able to issue bonds, and there's no tax on that. So as per the law there, so they are paying 3.65%. The company is paying 5%. So which one is more attractive if you look at it? So if you look at it, on 5%, there is a tax rate of 35. Effectively, the company is paying 3.25. That's exactly what we need to look at from a company point of view. Why am I doing that? Because I'm saving money on tax. If the tax actually I had to pay, I would have paid down the entire money. The tax equivalent interest rate is this 3.65. I compare with my interest, tax rate. So effectively, they are saying if the company wouldn't have got exemption, the municipal bond, so they were actually paying this much of interest, 5.625 into 35%. If you do net of that, you will get 3.65. That's what it means. So we need to compare between a taxable instrument versus something which is non-taxable and see how actually is making more sense. So 3.25 versus 3.65. That's what actually the comparisons are. As a CMA, our decisions are these only. You see, both calculations result in the same decision. Municipal bond is a better investment. Why? Because if you are paying actually 5% and the company is there is a tax of 35%, effectively you are getting only 3.25. If you are comparing 3.25 versus 3.65, which one is better? Obviously, the investor will prefer a municipal bond. So company point of view also, you should see which one is better to invest, where I can get interest as tax free, or can I actually get something where it is taxed, but I have to pay a little more. You compare between these two. So it's from a company point of view, also from an investor point of view, we need to see tax whenever we do this calculation. If the tax rate was reduced, say for example, instead of 35, the new government has come in the US and they have reduced it to 25%. So obviously the calculation would still be the same, 3.65 divided by the new interest rate, new tax rate. Now the change has happened from 5.62, it has fallen to 4.87. So these are the decisions where we come into picture, the numericals. We were discussing about the covenants. So there are two conditions that further that comes in this. So as part of the covenants, you can have a call option and a put option. So these are derivatives in nature. So call option means literally the meaning of call. The company can call back after a particular period of time. Company can call back bonds. So basically, whoever is all the investors, the company can decide that, guys, please bring back the certificate. I will repay you now itself. So company has enough funds. So they have the flexibility to do this. That's a call option. They have the right, but not the obligation. But not the obligation. The definition of option itself is that we'll see that again in derivatives. So company can call back. You can always remember call back means call option. Put option is the other way around. Investor can ask for repayment. Put option means it is in the hand of the investor. So the covenants will have, say, after 5 years, 10 years. If the bond period is 30 years, after 5 years, the company can call back, call option. After 10 years, the investor can actually come and submit the bond and ask for repayment. That's a put option. Clear? Call option, company can call back. Put option, investor. Remember this, put option is related to investor. Call option means company has the choice. C for company. These are special provisions they have given here. Call provision is an example where the issuer, which is the company who is issuing the bonds, has the option of buying back the bond prior to the maturity. Instead of 30 years, 5 years itself, company has decided that I will repay this off. I don't want. Convertibility. Now, instead of actually repaying, instead of continuing for 30 years, you can also have a covenant called conversion. What is conversion? From debt, you convert into equity. So you can also have one more covenant, convertible. What is the meaning of convertible? You convert bonds into equity shares. So little bit of journals here. When I'm issuing bonds, I'm getting money into my account. So I'll get bank to say bonds. If I am using this conversion, so this bonds I will reverse to equity shares. Easy. So that's why you should know the journal entries, why I did the basics of accounting, the rules of accounting. This, you should immediately be able to capture this. So that you should also remember how the accounting will work, even if it is not asked for us, because this will help us in your decision making. That's why. So again, I repeat, your covenants, it can be a call option where the company has the right, but there is no obligation. No one can put a gun on them. The meaning of option is that only. This is the definition of option. Put option, investors can come back and submit the bond and ask for repayment. So these are part of your covenants. The third covenant, it can be convertible. So bonds will become equity shares. Journal entry, bonds to equity shares. There is no cash movement at all. On your balance sheet, from a long-term debt, it becomes equity capital. So they also will be now, part owners of the company. They can get dividend, but they will not get any more coupon. So this will also impact your decisions. See, if you do this, you don't need to pay any more coupon. You understand that. But they become now part of controlling the decisions. Shareholders have control. So what is the yield? So the rate should be, like I said, first minimum you should pay whatever the US government treasury is paying. And then you should see how much is the risk that your business is all about. You should be able to assess that and start giving little more than that, the premium. You have to do that because there is no other option. See, that's why a default premium. What is the default risk that people are worried? How credible is your organization that people are gauging? So your analyst will help you. The advisors will help you that, sir, if you are going and issuing bonds to the public, they are scared that whether their money will come or not. That's where default premium, it has to be higher. Again, liquidity. How liquid is your bond is going to be on the exchange when it gets listed? So will people come and invest? They have to project all these things. It's a challenging task. That's a liquidity premium. And then for taxation and any other provisions that you have. So all those things will come as part of the decision making. So this is what exactly As a CFO and the entire team, including CMAs like us, uh, are part of the decision making of deciding how much should be the premium on the interest rate that you pay. So if the US government is paying 2%, should you pay 6%? Should you pay 4%? It all depends on these. So just take this example. The US Treasury bonds is 2.5%. So they have calculated for all their research and all that the default premium is so and so liquidity premium, and they are, because of some tax exemption, they are getting a discount. Ultimately, they decided 2.795, which is 2.8% is what they have to pay. So if you look at it, government is paying 2.5, we are paying 2.8. You have to be always higher than the government, otherwise no one will come and invest. So we'll see tomorrow this inflation thing and the yield curves.
Okay.
So let me recap the bonds so that tomorrow straight away we'll move to yield curves and whatever is the next topic. So we started discussing with the uh, common stock. When we go to the first time to the public, we know it is called primary market or initial public offering. We always issue at face value plus or minus. The plus is called additional paid in capital. In India, we call it as share premium. It can be at a discount also. The dividend that you declare is always declared as a part of face value. So if you declare 10%, it will be $10. The current market price after it gets listed, it is a secondary market. Dividends are optional. The company might or might not declare. There is no legality that we should declare. That's for equity shares. Then we looked at bonds. Bonds is a debt instrument. No one is becoming owner of the company because the company is issuing bonds. So investors do not have the right to become owners. No, they don't get. That's why it's called a loan, a debt instrument. So you need to understand the difference between these two. What is that I have to pay? Every 6 months, I have to pay coupon. Coupon is interest. Again, it has to be calculated on the face value. When you are issuing, again, just like shares, you can issue it at a premium or a discount. The tenure can be 1 year, it can be 5 years, it can be 10 years and 30 years and so on. Most of the US based governments are 10 years and 30 years and all that. So whichever is the company which is raising funds through bonds, they have to create a separate sinking fund by forming a trust. The bond trust takes care of the issue of IPO, the every 6 months payment of coupon, and the final repayment of the face value. In US, generally the face value is 1,000 US dollars. The document in shares, we call it as prospectus. Here we call it indenture. Indenture is basically the terms and conditions. The word conditions we use in bonds as covenants. It can be positive, it can be restrictive. Positive, where we are actually asking the investor that, sir, I am going to earn this much of gross profit. It's a promise actually. Whether it happens or not, no one knows. But it's a promise. They'll try to use as much forecasting. Again, we come again in that role as a CMA, that how much they should promise. Can they deliver that? So because when people invest, there will be funds which are investing into your bonds. So they will ask questions on these. So we should be in a position to justify if you are the person who is deciding this. How much gross profit, how much revenues, all these are positive. Negative or restrictive is I will put a cap that I will not cross beyond the limit of loans, or I will not use this anything other than only for say highway project. So these are restrictive covenants that are also very popular. We know whenever it gets listed, any financial instrument, there is a current market price because the trading is happening. The word yield comes into picture. What is the yield? Your coupon divided by your current market price. So if the current market price falls, your coupon, your interest, your yield actually goes up. Your coupon will still remain the same, your yield actually shoots up. The relationship which is inverse between price and your yield is called bond duration. So this bond duration is very, very famous, and it's a relationship which is what everyone looks at. So if the yields are actually shooting up, the prices are actually coming down. Or if the prices are shooting up, yields are actually coming down. So this also impacts the economy. It's not just for a company. So there are a lot of economics behind this. But point is, this is very important for us also. The interest that you are paying, the coupon, is always tax, benefit. So it is always EBIT minus interest. You will get EBT. Then only you pay your tax. So the tax benefit that you are getting by reducing from your revenues is called tax shield. There are other covenants also. One, call. Call option means option definition itself is a right, but there is no obligation. Company can call back as per the covenant. Covenant says 6 years. I can actually call back. It's a company decision. They have money. They might decide to call back. It's a right. There is no gun that you can put on them. Call option, remember company. Put option, investor can come back and after a particular period, 6 years or whatever, as per the agreement. So they can come and ask for repayment and company has to repay. Last but not the least, convertible. Bonds will become equity shares after a particular period of time. There are rules and regulations behind all this. We need to just understand how to make use of this. That's our job. Journal entries, when you are issuing bonds, whatever, bank to bonds, when you are converting, bonds will get debited. So you reverse this entire thing and you make it equity shares.